Good afternoon, everybody. Unfortunately, due to some technical difficulties, I had to record my conversation with Jowdy in reference to the forbearance. We did answer some of the questions that came in. If you had questions and you're waiting to ask them on the live video, please message me and I will have Joe answer those questions personally. So I hope you find the information that you're looking for in this video. Thank you.
I've been getting a ton of calls about this forbearance, so I figured there was no person better than to answer some of these questions. So can you tell us a little bit about what's going on?
Sure. Thanks for having me. First of all, forbearance is a word we're hearing now because of the corona situation that's going on. First, we need to define what it is and the kind of the misconceptions. Forbearance does not mean payments are forgiven.
Right.
Forbearance means your lender or servicer, your loan servicer, halts or modifies the payment to give you a pause. And in order to qualify for this kind of relief, this forbearance in this environment, you have to call up your servicer. Obviously, they're not going to contact you, and there's no blanket rule like all mortgages are in forbearance. You will have to reach out individually, each borrower, to their servicer, their loan servicer, and request 1 month, 2 months, 3 months, however many months they're willing to grant for their payments to halt. I think the kind of the misconception is people think, well, yeah, if I qualify for forbearance, maybe I've been laid off, maybe I've been furloughed, what have you. That's like free payments, right? That's like free money, and it's not.
Right.
And there's a lot of, and we were talking about earlier today, just on some separate business, how it kind of impacts the whole real estate and mortgage system as a whole. Forbearance is a big deal because, there's trillions and trillions. I want to say the $8 or $9 trillion in residential mortgages out there. So if loan servicers take a 1 or a 2 month break from collecting payments, that can tank a lot of good mortgage companies, a lot of loan servicing companies, and that's not good for anybody. It's certainly not good for the consumer. It's not good for the real estate market.
Yep. So yeah, like you were saying earlier, if you can make your payment, you need to make your payment.
Yeah. So, well, first of all, because if you have the money, why not make it? You're not saving anything. You're going to have to make it anyways. So if you have the money, meaning you're still fully employed, you're not working, living paycheck to paycheck, you can make your mortgage payment. Make it, because then you're helping the overall system, and you're not saving anything by not making it anyways. You're just tacking it on to the end of the loan. Forbearance is for people that are in tough shape right now. They've been laid off. They don't have any kind of reserve fund. So they're in a situation where it's, do I buy groceries or do I pay my mortgage? Well, you have to eat. Okay, those people are good candidates for forbearance. But if people start doing it that don't need it, it will eventually cripple the system. And there's scary. That's why you're seeing these massive swings in the financial markets right now. Is banks and lenders and servicers are worried that people are going to take advantage of it when they don't need it.
Yeah. And I do have a lot of investors that are using their properties as leverage to purchase other properties.
Mm-hmm.
So if they partake in the forbearance, does it count against them? And if so, how long would it take to for the banks to start lending to them again?
Well, remember, forbearance, you're not penalized. So if your lender grants you forbearance, it does not negatively impact your credit, and therefore does not negatively impact your ability to get a loan down the road. So, and we saw this just a couple of years ago with the big hurricanes. Some people qualified for forbearance for a month or so because maybe their homes are destroyed or they were out of job, what have you, and their scores did not go down. Their mortgages were not adversely impacted. They were able to take those payments and put them on the end of the loan. So you're not necessarily setting yourself back. Now, if you continue to miss payments past the time that your lender has granted you forbearance, then your credit starts getting dinged. And when you have a mortgage late, okay, that's a major impact to your credit. It's not like having a credit card late or even a car loan late. Once you start skipping mortgage payments and your lender has not allowed you to do that, it's big time, and your score can plummet instantly.
So if someone wanted to participate in the forbearance, what do they need to do? What are the steps for them to do?
So the government has set up a website. It's consumerfinance.gov. And if you go in there, there's all kinds of answers to who you should contact. It's going to depend on who your loan is with, who's servicing it, who the end investor is. You can even go directly, you're on your mortgage statement, there's a servicing number. You can call them directly. But if you want a centralized site for answers on what forbearance means to you and what you can expect, you go to consumerfinance.gov. They just got it up over the last couple of weeks, so it's kind of moving along and it's fluid. The information that's on there, it's changing every day, but it's been a good help, I think, so far to a lot of people.
Perfect. So in addition to a bunch of the forbearance questions I've been receiving, a lot of them are coming in and wanting to know about refinancing. So if I can field some of these. Someone asked, they just purchased not too long ago. Is there a waiting period for someone to refinance right now?
After they purchase?
After the purchase.
Yeah, no, there's no, you can, assuming they got a conventional or a jumbo or even a VA or FHA loan, you could technically refinance the day after you purchase a home. Typically, there's not much benefit in doing that right away because rates, it's not like rates have swung that much over the last couple of months. They've come down a little bit, but remember, when you refinance, there's always cost. Even if you don't think there's cost, there is. Whether it's because you're recasting your mortgage or you're paying fees up front to get a particular rate. So you have to weigh that against the savings that you're going to recoup as a result of that lower rate. Now, because of all the chaos in the financial markets, because of the coronavirus, rates did plummet quite a bit over the last week, but they've kind of come back up in the last day or two. So that's kind of they're up a half a point, down a half a point. Even before all this, we were in the high 3% range for a 30-year mortgage, which is close to historic lows. Now we're in the low to mid 3% range on a 30-year fixed mortgage. On a 15, we're in the twos. We're locking 15-year fixed rates at 2.75%. So I've never seen that in 20 years of mortgage lending. So it is a good time to refi for people. But it's not necessarily something you want to do if you just bought a house. Because like I said, you got to weigh, okay, where was your rate when you started? You just paid a bunch of costs to get that loan. Does it make sense to go ahead and get another one right off the bat? But that's why you call your lender, you talk about it, you do a cost analysis. And it's at least a good thing to look at. Not for everybody, but a good thing to look at.
And then now here's another one. I have a great deal of equity in my home and my current career is not in jeopardy. Should I refi to pull out the equity that I have now?
Well, your equity is yours, whether it be whether you take it out and you put it in a bank through a refi, right, which is called a cash out refinance, or you keep it parked in that house. I've never been a big advocate of using your home as kind of a piggy bank and stripping out all the equity, because remember, when you do a cash out refinance, your mortgage payments go up, right? Now your mortgage payment is that much higher. So it's a good time to do it if you have some maybe high interest debt to pay off and you have some good equity in the house, sure. If you're going to consolidate some debt, sure. If you need to do some home improvements that are going to maybe increase the value of the house, sure, that's a good investment. To just strip all the equity out or as much out as you can to put into a bank account for a rainy day fund, I don't think that I would advise that. There's other things you can do. There's home equity lines of credit, which are tied to your house, where you don't necessarily have to pull all that equity out. It can just kind of sit there and be there if you need it. That's probably a better idea for that kind of person.
Okay, and then another question was, a lot of companies are furloughing people, but with the intent to bring them back. Mm-hmm. If someone's already been pre-approved, is that going to affect them, purchasing a house?
Yeah, so that's something we're seeing change in guidelines daily right now. It's based on their income, if they're self-employed, if they're commission-based, if they're just straight salary. And what we're doing as lenders is making sure that we verify the employment at the start of the process, but now we're verifying the employment at the very end, not just a few days before closing, oftentimes at closing, and on some refinances post-closing, because a lot of refinances, if they're owner-occupied, they don't fund until 3 days later. And that's, again, something that's being done to protect the general mortgage market. Because if a bunch of loans go bad, it's such a massive, it's the United States residential mortgage market is the biggest credit market in the world, okay? So if a huge percentage of these loans start to default, even if they don't go into foreclosure, if they just start to default, that really puts a lot of stress on our economy. We saw it in 2008, and I think politicians, regulators are trying to do everything they can so that we don't have a repeat of that, because that trickles down, it trickles through the system. And instead of the coronavirus being a problem financially for a few months, it could turn into a few years because of people losing their homes in foreclosures and things like that. And that's what we don't want to have happen.
Absolutely. Well, Joe, I know you're busy. I definitely appreciate all the time that you gave us today. And could you give the listeners your information in case they have some questions that they want to contact you directly?
Sure. We're at First Equity Financial, fefloans.com. And it's 866-999-0003.
Perfect. Hey, thanks so much. We'll talk to you soon.
All right. Thanks for having me. Bye-bye.